thanks for joining me for this brief market video. I just wanted to address the recent election results, the impact on the stock and bond market, and of course the impact on your portfolio. The evening of the election, we saw world markets drop pretty severely around the world. However, most recovered pretty quickly, and in fact in the US, the day after the election, the markets actually closed up for the day. And since election day, we've seen the equity markets behave pretty calmly for the most part, and that continues to be the case in each day that we monitor these events very closely. However, that has not been the case on the bond market. Now, bonds and interest rates move in opposite directions. When interest rates go up, bond prices go down. And the reason for that can be illustrated by an example. So let's say that you invested in a high credit quality bond that was going to pay you 5% interest for 5 years, and you invested $10,000. 5% of that $10,000 is $500 per year that you would receive every year over the course of those 5 years, and then assuming you've invested in a high credit quality company that pays that principal back, you would receive that $10,000 along with all of those years of interest. So, seems like a pretty good deal. However, let's say that 2 weeks after buying that $10,000 bond, there's a new bond that's being issued by a company that has a similar credit quality, except they're paying 6%. Well, any investor would obviously rather invest in this new bond that's paying them $600 per year versus that $500 per year on the 5% bond. So for that original 5% bond to be tradable on the market, its price would need to drop so that its yield or income would be about the same as the newly traded bond. It doesn't mean that you won't ultimately get the full $10,000 back on that bond if held to maturity. It just means in the interim it is worth a little bit less. And that's the impact that we're seeing worldwide on interest rates. It's also impacting mortgage rates and other interest-bearing investments. This is a trend that we see as very short term. We don't think that interest rates can continue to rise at that rate for a very long period of time. In fact, this increase in interest rates that we've seen is the largest in a 1-week period in a quarter of a century. And so not only do we think that interest rates will not continue this rise, it's my opinion that we'll actually see them come back a little bit. And so in your portfolio, if you hold individual bonds and hold them to maturity, you'll receive that principal and interest back. And that's our primary strategy in almost every client account. So it's a move that is not very concerning to us, and in most portfolios we're doing very well year to date versus the market averages, but it is a situation that we are monitoring closely and we will take advantage of if we see opportunities in either the stock or the bond market. Of course, each of our portfolios is customized for the specific needs of each client, so if you have questions, as always, please feel free to call our office and one of our advisors would be happy to talk with you. With the holidays coming up, we hope that you and your family have a very happy Thanksgiving, and as always, if there's something we can do to help you, please feel free to call our office. Thanks very much, and we hope you have a great day.